Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 261st podcast videocast for the week ending October 16th, 2024. A lot of incredible stuff to cover this week. First, family first, then we'll get down to business. We were out in Phoenix, Arizona this weekend, and Mimi and Annabelle's team, 908, won the entire Rocktober tournament, first place. Absolutely incredible weekend. There are the girls, and that's the amazing team. Had an amazing goalie. We call her Blockada. Unbelievable job. That's me with Mimi. That is unrelated photo in the green room doing Cavuto yesterday at Fox headquarters. That's me with Annabelle. That's the whole family after they won the whole darn thing. It was absolutely amazing. Caitlin, Annabelle, me, and Mimi. And then that's me with the girls. And that's the hallway before you walk into the studio. You can see it right there. So those are the photos. Also, super excited. Unbelievable raise. We're closing on Friday. Anyone that hasn't yet come in will close out on Friday, so long as you click on money management here at hedgefundtips.com and get your inquiry in before then. You can be included in this final raise for 2024, which closes Friday. Want to thank all the new people that came in. Michael T, Ryan, Jake, Rick, Damian, Blake, all the existing people, Micah, Abhishek, Stephen C, Steve D, James G, Seema, Dale, Andrew, Pat, John, Philip, Craig, Rachel, Woody, Rob, Chris, Brian, Frank, Srini, Paul, James T, Lorraine, and that's that. Oh, also want to acknowledge Amara, who is their coach of 908, also did an unbelievable job. And I forgot to cover a couple quick videos. They're only a few seconds each. Here we go. There's me. All right, that's Mimi. There's Annabelle. And then she gets the follow-up here. Boom. And finally, we have got the last one. There's Mimi. Boom. Lefty. Unbelievable. Then I joined the great Neil Cavuto on Fox Business yesterday. Want to thank Neil and Jenna DeTomasis for having me on, and my buddy Lou for making the introduction. Lou Bassanese, you're awesome, man. And so we're going to listen in here.
That's coming up 4 p.m. Eastern Time. Ahead of that, we have Thomas Hayes back with us, the chairman and managing member of Great Hill Capital. Always good to have Thomas. He's a very smart young man. What do you make of what the banks, first off, told us, Thomas? I mean, steady as she goes, some bumps along the way, but not nearly as many as some feared. And they are sort of like telegraphing something. What?
Yeah, there's no question about it, Neil. The key here for all of earnings season, including the banks, is expectations, because profits were down year on year in aggregate, but expectations were lower.
Very good
point. I think that's also going to be the theme with the general market. Expectations were 7.8% earnings growth at the end of June. They're now 4.2% earnings growth. So I think that's a low bar that we can beat, and the market likes beating expectations. As it relates to the banks, the fears were around net interest income, which Brian Moynihan, who you have on your show at 4 o'clock, said troughed last quarter. So that's positive news, and it was more than offset by deal making, predominantly equity and debt issuance, as well as trading as well. So
yeah, I was noticing in case of Goldman Sachs on fire with all of that deal making and all the hyperkinetic activity on Wall Street. Do you ever wonder that there's almost too much gas there?
You know, we have this beautiful combination right now of massive liquidity. We had more central banks cut last month than have cut since 2020, and prior to that, 2009, and that's historically a good thing for equity. So you have liquidity, plus complacency. And this could be the first October for an election year where we've seen very, very limited volatility. So I'll be interested to see what happens in the next 2 weeks before the election. Do we get any of that normal chop pre-election like we usually see in presidential election years, or do we just power through? And right now the market's voting with liquidity and beating expectations so far.
Donald Trump has said if he doesn't win, we're going to have a market crash.
Yeah.
What do you think of that?
I think that all presidents take too much credit for the economy, whether good or bad, or are assigned too much credit when it's bad. I think the key thing that the market wants historically is checks and balances. So
yeah, we do better under split government.
Under a split government. So long as one party doesn't get the presidency, the Senate, and the House, I think the market's going to like it. I think, you got GDP now up 3.2% from 2.5%. You have rail freight car loadings, which bode well. They're up. That bodes well for a manufacturing recovery. We've been in a manufacturing depression or strong recession for the last 2 years, despite the rest of the economy picking up the slack.
You talk about the rest of the economy. I look at the rest of the market. It used to be concentrated in technology. Technology is still doing fine, but it has widened out considerably, and hence this argument that as we enter a third year of a bull market, we could easily match the average length of a bull market, 5.5 years. Some have gone on for a decade or more. How do you see it?
I love it. I love the broadening that's happened. That's a sign of health in the market. And thematically, what you see at the beginning of an easing cycle, we just got 50 basis points, we're 25, 26 days in, is broadening. So the unmagnificent 493 are now going to start to outperform the magnificent
But
7.
By the way, did you notice with the magnificent 7, I was shocked when I read their multiples, trading at 28 times earnings. And a lot of that has to do with the fact, the stock prices have soared, but earnings have soared. So it makes the math more compelling and not nearly as nosebleedy as we had through the internet boom.
Yeah, and I think why you're seeing the 493, though, pick up is because the earnings growth of the Magnificent 7 is decelerating. It started the year at 50%, it's down to mid-teens, and the unmagnificent 493 were negative earnings growth until the most recent quarter inflected positive, and they're going to move up to mid-teens. So that there's huge opportunities under the surface.
So let me pursue that. I think you were touching on when you were talking about maybe 4.5% earnings growth. That's off the original estimates of close to double that, right?
Exactly.
For the S&P 500.
Yeah.
UBS has said something similar, out with a statement that they think earnings will contract a little bit, not go reverse, but we will see a sort of a tightening of that. Now, what would that mean if they're right, if you're right, for the stocks?
Yeah, I think as long as they beat the low bar of expectations, that's going to be the key. And looking out to 2025, you're looking at 15% earnings growth, and margins are actually accelerating. So we're
So this will be just a quarter phenomenon type thing. It picks up as the time goes on.
And that's the thematic. From all the data that we look at, it looks like a short-term pause and then a reacceleration. And that's a function of liquidity and things starting to move again.
All right, got it, my friend. I always think that these guys play with us here, don't you? Where they say, we're going to have horrible numbers.
Right.
And if you just mildly beat it, I pulled that stunt with my parents on their report card. It's going to be all Fs. And they see a couple of Ds and Cs and they think I'm mentioning it.
Neil, the secret to happiness in life is low expectations, and that's exactly what the earnings game is all about.
I built a career on it, my friend. Always good seeing you, and I really appreciate it, Tom. Tom, excellent, uncanny read of these markets. Another uncanny read of politics is.
And we're back. And then I want to thank Reuters for including me in their article on banks yesterday, as well as Allison Lampert and David Shepardson for including me in their article on the strike with regard to Boeing. What I said on that article was striking workers who temporarily do not have a paycheck, do not want to become permanent unemployed do not want to become unemployed workers who permanently do not have a paycheck. I would estimate the strike will be resolved within a week, as these workers do not want to find themselves in the next batch of 17,000 cuts. Boeing cut 17,000 people in the last week. They're raising $10 billion of capital. As a matter of fact, while we're on the subject, I put this post out today. Boeing's raising $10 billion of equity to wait out the strike. That was already priced in, which is why the stock is up. The total assets of the International Association of Machinists Union are $300 million. That is the magnitude of their reserves. The IAM is paying their members $250 a week to strike, while the president of the union makes $330,000 and has rejected a 30% pay increase for the workers. And I know many of you listening to this VideoCast podcast are like 30% raise and they're not taking it. These are six-figure jobs, ladies and gentlemen, for the most part. So the $300 million is the collective assets of the 530,000 members, of which only 33,000 are Boeing. So you got to look at these other 500,000 workers who have been contributing to this fund that Boeing is draining after being offered a 30% pay raise. Very hard to pay mortgages and car payments on $250 a week when $100,000 Boeing jobs are on the table and being rejected by union leadership that earns hundreds of thousands of dollars per year. Will be interesting to see how the other 500,000 members feel about their collective reserves being worn down by the Boeing strike. So I think this comes to a head. At the end of the day, 10 billion versus 300 million, you know who has more weighting power. It seems like it's not like, oh, the workers are wrong and Boeing's right or vice versa. It just seems like a reasonable offer. Inflation has gone up much less than 30%. So 30% seems to be a reasonable catch up to get everyone back on track. Maybe I'm wrong. Maybe it needs to be 35%. Maybe it needs to be 25%. But at the end of the day, Boeing is in the stronger position here, and I think this is going to lead to a head and a resolution, and hopefully very positive for the workers, and obviously very positive for the company and for all the airlines that depend on their planes that have been waiting for those planes. Moving along, some quotes of the week. There are quite a few here. First one is from Peter Lynch. I think you have to learn that there's a company behind every stock and that there's only one real reason why stocks go up. Companies go from doing poorly to doing well. That's our specialty. And small companies grow into large companies. And we got a couple of those as well, which is exciting. Buffett, in this same vein, says risk comes from not knowing what you're doing. And those are people who just look at stock tickers and chase what's going up, the shiny objects, and then get their heads handed to them in time. Not always right away, but sooner or later it always happens. And then finally, which is basically the ethos of our entire business at Great Hill Capital, which is great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. And that's what we specialize in, and that's what we try to impart to our awesome viewing and listening audience here at Hedge Fund Tips with Tom Hayes, live from Connecticut this week, by the way. So, first image we want to talk about is the 493 to post profit growth for the second straight quarter. You can see the yellow line of earnings growth converging with the black line of the Magnificent Seven. You can see Magnificent Seven, which we've talked about a lot, was up at 50% in the first quarter of this year. Earnings growth on Magnificent 493 was negative. Now those are moving towards the mid-teens, while the Mag 7 is moving down to the mid-teens. And you say, well, if the Mag 7 is still going to have mid-teens earnings growth and the Unmag is going to get to mid-teens earnings growth, why doesn't the Mag 7 keep going up? Because the Mag 7 was priced at 28 times earnings and the equal weight was priced at 18. So you can pay, basically a third, 33% less for the same earnings growth if you are outside the Magnificent Seven. So I hope that answers everyone's questions. That's a very important statement right there. This is from Ryan Dietrich over at Carson. Wanted to cover this one first. It talks about how long can this bull market go. It just turned 2 years old, but it's still young. And he takes all the post-World War II bull markets and works it down to the average is 5.5 years, so we're 2 years in. And the average gain of the bull market since post-World War II bull markets is 191%, and we're only at 63.8%. So we've been talking not just since 2022, since 2020, since the COVID lows, and many of you were with us back then, how we thought this thing could run till 2030 to 2032. So for those of you who have come in as clients, we've got a lot of exciting stuff to do over the next 6-7 years. The other thing here is the ranges are just, 1987 to 2000, and we've made the case that we think this is mid-cycle of an 18-year secular bull like we saw from 48 to 68 and 82 to 2000 based on demographics, with the millennials being the bulk of the population at 33, 34 years old, and their spending doesn't cap out till the early 40s, which gives us another 6-7 years. And those are the ones that you saw. Same thing with the boomers, 87 to 2000, 582%, big run. So, all right. And then here is the other thing. Year 3 of bull markets, where we are now, tend to be a little bit weaker. And that is consistent with what we've been saying, ladies and gentlemen, which is the heaviest weights would underperform and the indices would remain subdued. So those passively indexing are going to be hurt, and those that are exclusively in the S&P 500, and those that are stock picking under the surface from the unmagnificent 493 and know the underlying company and know what they are doing. It's so funny. Investing is such a funny thing, in that every single day people will go to get heart surgery, and they go to a heart surgeon because they're a specialist who's devoted 20, 30 years to seeing thousands of cases and different variations and knowing the rules and knowing the exceptions to the rules to become a great heart surgeon. And yet no one ever walks out of surgery and says, I could do that. When their wife needs a heart procedure, they never say, I could do that. And yet with investing, you see it all the time. And I would say in some cases, the investing results are probably as important, if not more important than the heart surgery, but kind of up there. Money is not everything, but it's right up there with oxygen. So leave it at that. All right. So here is the some of the charts that we want to cover this week. We got a huge amount of data. Let's see here if I can make this bigger. Some of you have asked for that, and it makes it easier for me to read as well. Ooh, that's nice. Okay, so let's go here. Private client weekly outflow from T-bills is the highest we've seen. This goes all the way back to 2000 to 2003, which we're going to see. This bull bear indicator is getting really towards extreme bullish, which is not, that's time to be a little more cautious, certainly in the heaviest weights. Record inflow into Chinese equity funds. That happened at the end of September, which we said they were going to get punished. All the skeptical people who got excited, we look at BABA a lot. When it got back up to 120, we're going to get smoked. And I said the max pain would be if it breaks below 100, it just flush out all that late money. It didn't quite do that. It got down to like 101 or 102. Now it's starting to bounce again. I hope we see a flush down to 98. We'll reload on longer dated options. We've not sold a single share of stock, obviously, but we made a ton of money on the options. But we wouldn't mind reloading. So let's pray for 98. If we don't get it, then we'll just make a ton of money on the stock, and we already rang the register on the options. So that was an exciting part of the last quarter. Record outflow from Japan equity funds. Remember, we've been saying this. This was just Japan has nothing going on. This was simply a hot money flow out of China during the last 2 years when the government policies were unfriendly and non-stimulative like the rest of the world, and where Bank of Japan was stimulating every day. Now they've got to tighten, and this hot money is coming out of there. And it's also going to come out of India, by the way. But first Japan, because Japan has no growth prospects. India's growth prospects are phenomenal for the next few decades. It's just they're young. They're in their 20s, not their 30s. We want them when they're in their early 30s. That's when the game really takes off. Money market fund assets still at a record. So we saw this in May 2020. These are going to start to turn down, and all that money is going to be coming into equities. So we're excited about that, just like we saw in January 2009 when easing started. Quantitative easing, which we basically have had with the runoff. And now the cuts. Will probably get another 25, 50 basis points before the end of the year. And all of our positions that we've been talking about, whether biotech, which is moving, whether China, emerging markets, small caps, we're all predicated on the easing cycle beginning. And as amazing as it's been the last few weeks, it's just gotten started. We're only 27 days in, ladies and gentlemen. So cool stuff. The Price is Right. Traders chasing China stocks, but allocators skeptical, a big inflection point, especially ahead of the U.S. election. We buy any China dips as policymakers saying capital markets to be used aggressively to boost domestic animal spirits and demand, and expect China GDP upgrades from 4.6%. China bond yields up from 2% floor to spur asset allocation into China, which we talked about. We wanted to see rising yuan, which we've started to see. We wanted to see rising bond yields, which we started to see. This is all stuff that we had been talking about in recent months that is now playing out. Go back to the tapes. CPI, 2-year percentage change. So it hasn't dropped this precipitously since the beginning of the secular bull market from 1982 to 2000. Same exact story you can see here. And we covered Ryan Dietrich stuff. Okay, manufacturing continues to struggle while services stay resilient. This is changing, though, because if you look at rail freight carloads and also overlay manufacturing PMIs to rate declines, easing cycles tend to spur manufacturing. So this will come back. This is just coming off the floor like you saw in 2011 and like you saw in when? 2001 to 2003, ladies and gentlemen, my favorite analog, which I cover, 20 times every single week for the last 5 months. Percentage of country with services PMI above 50. So this is what a recovery looks like, the beginning stages of a recovery, not the end stages of a recovery. Accelerated recovery in U.S. free liquidity augurs well for equity markets. So this liquidity, M2 money supply, easing cycle just starting to turn up. And consumer expects 4% earnings growth in Q3, consensus rather. They've set the bar low like I talked about with Neil, so they will beat it. They're already at 5%, largely fueled by banks. And we'll probably finish up 6%, probably 2 percentage points, maybe 2.5 to 3 percentage points above the 4.2% expectations, which will be good enough for government work. S&P 500 companies beating consensus expectations, so you can see by sector. This is pause before reacceleration. 7 out of 11 sectors are expected to see decelerated earnings growth in Q3, followed by reaccelerating earnings growth in Q4, which is why we've been talking about consumer discretionary, and this creates an enormous opportunity moving forward. It's all about demand. Watch rate-sensitive sectors. Historically, volume drove margins, operating leverage. Cyclical sectors have exhibited biggest operating leverage: energy, consumer discretionary, Cooper Standard, just kidding, but not kidding. Industrials, materials, and tech. Moving into 2025, we expect a healthy volume recovery in manufacturing goods sectors that have been pressured by higher rates, which should translate into upside EPS driven by operating leverage. Your Stanley Black & Deckers, your Generacs, your Cooper Standards, your GXOs, you name it, we got it. Demand recovery equals higher margins, which is awesome, by the way. The rumors of margin demise have been greatly exaggerated. They're holding up higher than ever. Energy, consumer discretionary, industrials, materials, and tech have historically had high leverage. Easing rate pressure should translate into a pickup in manufacturing. So you can see here throughout history, going back to 1972, when rates ease, manufacturing picks up. And if you get a Trump in versus a Kamala, you're going to see a huge increase in the amount of manufacturing that's going to be done in the U.S. Druckenmiller was out saying today that the market is convinced that Trump is going to get reelected. I'm not sure. I don't know. That's not what I do. I don't do politics. I will say the reason we're doing the podcast early is I'm going to the Al Smith dinner tomorrow night, which I do most every year I can. But in presidential years, it's unbelievable because historically, for 30, 40 years, you've gotten both presidential candidates come in and kind of make jokes for a couple hours. This year, one of the candidates decided not to show up So it'll just be Trump tomorrow, and I was looking forward to meeting both, and I'll be happy to meet one, and it'll be a fun night. So a friend asked me the other day, what do you need to be in? What's the Trump trade? And the number one thing that will absolutely rocket if Trump gets elected is small caps. They're going to do well anyway, just because the stage is set. But if you remember back to 2016, what moved? Industrials, small caps, manufacturing related stuff, etc. So that's going to be we're regardless of who is elected, those groups are poised to move, but the amount of the move will be exacerbated by Trump. And if you remember, Chinese stocks did better than ever under Trump, despite all the threats of tariffs. He is someone that wants to make deals, and we're going to cover that. Marcel Munch pointed out oh, come on. Why does everything log me out? Okay, here we go. HSI. Okay. So Trump got elected in 2016. Literally, the market just went straight up after he got elected. Absolutely straight up. This was a double in 2 years. So there's that. And then moving along, the restocking cycle, which has been the core basis of our thesis for the last year and a half since the 2022 lows. It continues to improve, continues to play out as anticipated. All of you remember when this was at its low when I was talking about it. We're going into a restock cycle. We're worked through the inventories, and here we are. It played out as anticipated, which is just the beginning of a recovery. 2009 to 2011, you still had 9 more years of recovery. How about 2001 to 2003, ladies and gentlemen? Well, 2003, you had the recovery, and then you kept rallying for another 4 years. Same story will be the case. Current mortgage rate is a tipping point to drive refinancing. Russell growth versus Russell value, relative price to trailing EPS bodes well for a reversion to value. You can see it now moving in that direction. High PE dispersion usually bodes well for value investing. The performance of Russell 1000 over Russell growth over value. So you can see the mean reversion. Growth to value has been obscenely high, and then you get this reversion. When did you get the biggest reversion? 2001 to 2007. Again, how many times can I say that? Growth versus value elevated on a PE growth. Covered that. Crowded positions in growth stocks still evident based on factors. Low forward PE versus high long-term growth rate. So you can see that. Again, these are all at extremes. And if you play the other side, that's where big money's made. If you're patient and you're not on margin, so you can sit through the short-term volatility because the moves are most violent before inflection points. Small size neglected by active managers. You can see the data. By the way, if you're listening to it, it's unbelievable. I know many of you are longtime listeners, first-time callers. But if you can watch this and see the visuals, I'm a visual learner. It's a big, big deal. So growth versus value at ex-COVID highs, same story here. Value versus growth, historical discount remains extreme. Highest since when? 2001, before you had the biggest move in the shortest period of time. And going back all the way to 1982, which is another great analog for where we are right now. You had the most aggressive tightening cycle that then became an easing cycle. And what happened? Value outperformed growth for literally 12, 13 straight years in a row. So positioning and valuation argue well for value and income. Dividend yield inexpensive versus history. You have to go back to all the way to when? 2001 to 2003. Dividend yield neglected by active managers. Quarterly market breadth in Q3 was the widest in 20 years. When's the last time you saw it that wide? 2001. Guys, this is not rocket science. If you pay attention, you can make a lot of money over time. So number of CEO changes in 2024 is on the rise. This is great for what we do. We've got our Bracken Darrell. We got our Shane O'Kelly. We got our Alex Chris. There's a reason we bet on jockeys and we're patient. Even Baba had a change. That's the name of the game. Good quality business, change in management, reaccelerate growth, good companies when they're misappraised, and rinse and repeat. From bad breath to 67% hit rate, equal weighted S&P hit new highs in 2024, leading the regular index by 3.6 percentage points in Q3. Market breadth has shifted from record narrows in 2024 to a 20-year high, with 67% of stocks ahead of the index. Okay. Jason Gopfert says, you know who's not chasing stocks here is insiders. Corporate executives among S&P 500 firms have some of the least open market purchases in 13 years. So he's saying that that's case for a short-term consolidation. I wouldn't disagree. It wouldn't surprise me to see some level of consolidation. Certainly in the higher weighted companies in the indices where you've seen the lowest insider buying and the highest corporate buybacks, where that tells you everything you need to know. Saying one thing and doing something else. Both the Mag 7 and other 493s, okay, slow in Q3, reaccelerate and beyond. We covered that. Now, this is interesting. So this was, I think I got this from Bespoke. This is the presidential election odds in Polymarket. Trump went up. He's just shot up to 60% and Kamala down to 40%, or 58 to 41 in recent weeks. Not really. Anyway, politics is not my game. Like, literally, just give me a split government and we'll make money in equities. But this is pretty pronounced, and we'll see how it plays out. According to Druckenmiller, the market is convinced that Trump is going to be elected. I really did not have that level of conviction. So we'll see what happens, but there you go. Cruise lines, credit card spend remains, it's really, here's why. It's not, I don't care about political ideology. The reason that I didn't have that level of conviction is it's like virtually impossible. Just like it was virtually impossible for Trump to get reelected because we were in a recession due to COVID, 2 quarters of negative GDP growth. It's virtually impossible to not get reelected when you are in a strong economy. It's possible, but the odds are against you. And given, the question is, the people that didn't own assets in the last few years, i.e. real estate or equities, although many households now do through their retirement, they haven't felt the benefit. All that they've seen is the increases in price on the things that they buy every day. So that may be a silent majority that is causing these numbers in these objective betting markets and polls to be skewing upwards despite the overall economy, GDP at 3.2% for this quarter, GDP now moving higher. So we will see. We're prepared for all eventualities. At the same time, equity index valuations in the U.S. market are at the top of their long-term range, while other markets are not. So where can you find the best value relative to history is China and UK and emerging markets and Europe. So that's where we're focused. S&P 500 companies beating consensus. We covered that. Here is federal fund rate changes expected over the next 12 months. At its peak a few months ago, people were expecting 10 cuts. Now they're expecting 6 cuts. I think that actually makes a lot more sense. 25 bips. 6 times, maybe 2 times before the end of the year, and once a quarter next year. That should be more than enough. It wouldn't surprise me if the economy is strong enough that the terminal rate's 4%, not 3%. That's non-consensus, but we'll just put it out there. Our corporate misery index fell to negative Q3 for the first time since 1Q 2021. That is normal after you have these rebounds. You have these steep spikes, huge things, because your comps are higher, just like you had in 2012. So if you sold in 2012 on this basis, you got smoked because you had 8 more years of a bull run. Same thing in the 80s. You had this huge recovery from 81, then you retested down in 89, and you had 11 more years left of the bull market. So that's not necessarily a bad thing. Korean exports remain strong. That's usually a barometer for the global economy. On a sector comparison, stocks in Europe trade on much bigger discounts than they have typically done in the past. That creates opportunity, ladies and gentlemen. The light blue here is the median versus the current, which shows the sectors in which you can find the biggest discounts, which are most of them excluding real estate. One of the structural dynamics at play is that government debt levels are high and rising, just like they were when in post-World War II, when they borrowed a lot to beat a visible enemy, whereas this time we borrowed a lot to beat an invisible enemy, and maybe more than a lot to beat an invisible enemy would be more justifiable if it was a visible enemy, but it is what it is. How did they get it from here down to here? They inflated it away. They ran inflation 3 to 5% above trend until 1956. This dropped down from 120 and change down to 60, 57 by the mid-50s and never looked back, and then it inflects back up. It runs in cycles. Hopefully they'll do the exact same thing this time. And based on their start with a 50 basis point cut and the 30 billion a month roll off, it tells me that they're playing from the same hymnal. Next, we're here. This is the second week of reporting. Next week is the most important earnings week. 33% of the S&P 500 components report next week. And that's that. Expected versus actual results. Fed rate cuts. This is interesting. During a recession, you get more rate cuts than expected. During a soft landing, you tend to get less. And I think with the exception of 95, so we're expecting 200 basis points. Maybe we get less this time, like 98, and like some of the other times where you have a soft landing and the amount of cuts comes in at or less than expectations. So, what are we talking about? 150 would be less than expectations, which would be consistent with a soft landing, like 95, like 98 type of scenarios. Households directly own 38% of all equities. Mutual funds own less. Pensions and government funds own less. Foreign investors own more. And households own more, a lot more since 2010. City Economic Surprise Index turning up. So that's a positive, which we've covered. This is a chart from FundStrat about more items deflating even as core CPI flattish. So 44% of components are now coming down in the CPI basket. We expect productivity growth around 1.7% over the next few years, followed by a larger boost from artificial intelligence later this decade. That's from Goldman Sachs. So the productivity boost from AI is down the road. Estimates from economic research suggest that there could be a modest drag on productivity as a result of lower educational achievement. That's kind of interesting. And then seasonality for semiconductors. A lot of people have been bearish on semis. Maybe justifiably so. You see conflicting data, but historically, November is a good month for semiconductors. So just be alert to that following the election. We have exposure through Intel, which we like. I know you can't give it away, but just hang in there, ladies and gentlemen. You've got an implicit government backstop like you had with Tesla. Tesla should have been bankrupt 5 times. The government said we need EV to work. The government needs a domestic fab. All of these companies that everyone praises to high heaven, they don't exist without a reliable fab. So if TSM shut down tomorrow, NVIDIA would be out of business, AMD would be out of business. They are dependent on the kindness of strangers, and Intel will be a duopoly with TSMC or oligopoly with Samsung if you want to include them in the mix. But the government will stand them up and make them succeed in spite of themselves, and we will benefit as equity holders. Just patience, Danielson. Statistical tests suggest that initial claims led the unemployment rate by roughly 2 to 4 months on average, though they were less leading during contradictory turns. Okay, so that's kind of a bearish thesis. Number of hurricanes this year, so you see what's happening with Generac, even though the number is not even normalized. So there's probably more to come, and so far I've been talking to people in Florida, the amount of total loss of cars seems to be very high. Not even so much from Milton, more from Helene with that storm surge. So we'll see how that impacts. And maybe that's why Morgan Stanley took up their SAR for this year from 15.8 in North America to 16 million. And if so, that's going to be very good for Cooper Standard. We shall see. This is why you see consumer discretionary down to 2016 troughs before they recovered as well, or 2021 troughs before it recovered as well. Food at home versus food away from home, spread narrowed. So a lot of restaurants, there should be opportunity in restaurants moving forward. We're trying to find some ways to express that. There are a lot of ways to do that. So food away from home, year-on-year change. So the prices, so now that demand has come down a little bit, this is the time you want to be a buyer, not a seller. Food away from home, the prices have gone down. Remember, they were charging whatever they could, when the stimulus checks were out, people would pay $13 for a Big Mac. Now they won't pay $6. And that normalizes the market, shakes out the weak players, and then the big get bigger again. So keep an eye on that. And McDonald's is telling you that story with their stock price. Corporate buyback authorizations year to date have hit a record high. That's very interesting because that's largely big tech. And at the same time, the buys in big tech, or the net buys, actually the sells, have been aggressive. So just keep an eye, watch what they do, not what they say. China equities, we covered that. VIX tends to jump ahead of election. Let's see what happens the next 2 weeks. This is the seasonality of small caps, tend to be weak in an election year in the next couple of weeks, right before the election, like we saw in 2016. I made so much money on that. They fell so much right before the election. We bought a ton of options. So we'll see if we get some weakness. It actually looks like it's breaking out right now. So it might already be pricing in what would be Trump would be more beneficial to small caps than Kamala, but I think they would work irrespective of who had the executive branch, so long as the Senate and the House are mixed, and you get these big moves. Small caps always do unbelievably well November and December, so you want to be VR positioned for that. Companies with positive year-on-year price change. This is what you see coming out of recoveries. They come from these depression type levels in 2022, 2020, 2016, and 2009, and then they're off to the races. So again, seeing this stuff visually makes it easy. BABA is going to now be added to the Hang Seng family of indexes, so that's going to force a lot of institutional money into BABA stock, which will be the Stock Connect Hong Kong Index, the Hang Seng 25 Index, the Artificial Intelligence Theme Index. So anyone wanting to play AI in China, they're going to be a weight in that index, and the China Technology Index and the New Economy Index. And that goes into effect on the October 28th. So there'll be a bunch of new buyers in addition to the Stock Connect, which now they represent 2.8% of all the shares, which is big buying in a short amount of time. That is going to continue as the new stimulus rolls out. Small caps, IWM is bullish, triangle breakout to watch. Above its 40 and 200 week moving averages. This is from Bank of America. So it just says small caps are finally breaking out. They were the laggard. Now they're turning into the leader. And this is a whatever cup and handle, which means measured move would imply another 80 points on top of that. So we've got a long way to go, ladies and gentlemen. This is just getting started. This is from Marcel Munch. Found this article from BC Alpha, it looks like. Trump will make a deal with China. Investors are over-indexing to Trump's rhetoric on tariffs, focusing on statements he made earlier this year or in his first term, and ignoring the significant change in his signaling. At the Republican National Convention, only used the word tariff twice, and only in the context of forcing China to relocate manufacturing capacity from Mexico to the U.S. Yes, former President Donald Trump is talking about attracting Chinese FDI. If acted upon, it would be a revolutionary change in the U.S.-China trade relationship. First, it would separate national security trades from trade, adjusting U.S. trade policy to the realities of global multipolar environment. Second, it would resolve the trade dispute using tried and true policies from the 1980s. Would China accept the deal? Obviously, it has already surged outward FDI in an attempt to de-risk from itself. Too good to be true. Investors should remember the old adage that, quote, only Nixon could go to China. Similarly, only Trump can deal with China. His Democratic opponents are not allowed to allowed owing to the rigidity of the U.S. political context. Should investors buy or sell something? No, not yet. Wait for the trade war hysteria to set in with Trump back in power and fade all the Trump trades related to the trade war. In particular, we would fade any appreciation. Yeah, so in the U.S., I would fade any appreciation in the U.S. dollar induced by the start of the trade war. That's a counter trend move that's going to fall apart. And he's also talking about small caps. It's completely wrong about that. To achieve this, we propose the following. Okay. So this is the data about the international machinists have $300 million of assets relative to Boeing, who's just raising another $10 billion. They can wait them out. These are the assets here. Moving along, seasonal composite October 1st to December 31st. That is in election years. So here we are, October 16th. You tend to get more choppiness into the end of the month before you rally into the end of the year. Let's see what happens. We covered that from Carson. That's consumption. This is high yield OAS spreads are close to record lows. So that's going to be good for Cooper Standard to refinance and other small caps companies to refinance. Here is another poll. This has really just turned up since October 9th or 10th. I'm trying to think what exactly happened on October 9th or 10th. Must have been an interview or something. But it just went straight up for Trump and straight down for Kamala. We'll see. Again, these things, betting odds, polls, no one knows until they know. Retail foot traffic on a continuous upward trend, which has been a big deal. This is compared to 2019, and it just keeps marching higher. That's very positive for things like Vans, things like Goose, and others. Special calendar days saw a visit boost across all retail categories. This is S&P also from Bank of America, implying a 59.30 move for the S&P 500. We'll see if that's going to happen all at once, or it could also go back and retest the breakout levels before moving up. Time will tell. Moving along, China growth expectations surged to most optimistic since April 2023. This is the end of early October, so they were super bearish in September. Then you got the first batch of the stimulus. Now they're getting very optimistic. And as you can see, they don't tend to get optimistic for nothing. It tends to persist and persist and persist. This is the boom-bust semiconductor cycle. This implies that you could have a downturn, which would hurt the NVIDIAs and the AMDs. Again, Intel, it would probably draw more attention away from GPUs and back to CPUs, where Intel has a stronghold. So I think we're insulated if this proves to be correct. But again, here's 1, 2, 3 instances is not the best amount to draw a hard and fast conclusion. S&P sector returns during soft landing Fed policies. Healthcare tends to dramatically outperform. And financials, PayPal is a financial, ladies and gentlemen. Healthcare would include biotech, which has moved quite a lot. It's been consolidating. I think we're getting ready for the next move up, which is going to be awesome. We've been in that position for a while. Nice to see it moving, but just getting started. And profits from non-financial corporate business, excess liquidity, leading indicator, push forward. So we're seeing that the increased liquidity is going to lead to more increased profit. Here's the profit margins we were discussing, near record highs at 15%. Everyone was saying these margins are unsustainable here, here, and here, and yet they just keep climbing higher. Small cap exposures come down dramatically from 50% down to, it looks like 18% in the last 10 years. This is going to mean revert. IG's corporate OAS spreads we covered. Here's a bigger chart. And almost done here with the data. This is the Goldman Sachs Economic Surprise Index. What countries are having the most amount of economic surprises to the upside? UK, ladies and gentlemen, our GXO Logistics. Tiny position in ASOS started to spring up. We'll see. We haven't added to it yet, but we're looking at it. And then U.S., Russia, of all things, that's kind of interesting. Canada, U.S., Australia, etc. And what's having the worst economic surprises? India and Japan have been having negative surprises, where everyone is crowded and where no one's crowded, and China is starting to turn up positive. We covered the retail foot traffic. Trainer, this is interesting. Total containers coming through LA at new highs bodes well for retail sales, ladies and gentlemen. So that helps all of your consumer discretionary, in case you were wondering. Excess liquidity will turn higher if stimulus is working. This relates to China. This is going to start to turn higher. And then let's look at the Slumer stuff from RBC. This is from today. And as you can see, what did I say? The 10-year yield was a counter trend rally. The trend is going to be down, not up. It's got overbought. The trend is down. We were saying this is a counter trend move here, 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 and here. Now it's proving to be correct. Same it will be true with the dollar. S&P broke out, maybe checking back or maybe go straight up. We'll see. We're kind of agnostic either way. Relatively fully invested. Have a little bit of cash from all the option profits in recent weeks, but we have actually built a new position on Monday. We got a beautiful slug in accounts that had room and new accounts, but then it started running away from us. It's supposed to go down first before it goes up, but it went up right away. So we'll wait for that thing to take a breather and then maybe get it up to 6 or 7% position. So brand new clients know what we're talking about there, and existing clients that had room, we've got some there too. Semiconductor index, so that's that. Industrials, equal weights, broken out, etc. Okay, so that's that. Moving along, 5 numbers that explain why Boeing won't go bankrupt by Al Root. We know $23 billion in cash in last quarter, 6,200 unfilled orders, hundreds of billions of dollars of sale of backlog, tens of billions of free cash flow backlog. 2, this is a great article, by the way, by Al Root. He's one of the best over at Barron's, by the way. I know I was a little tough on one of the other writers, but this Al Root is money good. That guy just gets it right all the time. Backlogs are one thing. Further demand is another. Industry still in good shape. Airbus estimates the world will require 42,430 planes over the next 20 years, and they've got already 8,500 unfulfilled orders. So they're going to have half of that because it's a duopoly. So they got another 21,000 behind the 8,500 they haven't filled. And you can't give away the stock. You can't make this stuff up. Oh, ladies and gentlemen, it's kind of funny. Anyway, 13.6 billion. It's easy to see Boeing delivering more than 800 jets a year. Boeing delivered 806 in 2018. That generated 13.6 billion of free cash flow that year. I mean, it's just, what a great article, by the way. Look that up at Barron's. 5 numbers that explain why Boeing won't go bankrupt. And if it won't go bankrupt, it's going to be a double over the next few years, and then move beyond that. XPO spinoff GXO Logistics is said to explore potential sales. So the stocks moved up. We were, pounding the table in the high 40s. Now it's in the low 60s. This is somewhat disappointing to me because I got into this for a double plus, not a trade. But the rumor circulating out there is that if there is a deal to be done, it'll be close to $80 or $85. I would prefer they didn't do it because I think it goes over 100 over the next few years. But that's a champagne problem. If we make too much money too quickly, we'll find a way to redeploy. People's Bank of China starts $71 billion liquidity tool for stock investors, which was basically what Tepper was talking about. Which is non-recourse loans to buy stocks. I'm telling you, this thing's going to fly. I just hope we get back down to 98 so we can reload the options that we took profits on. Lululemon and Nike are less popular among teens. Why that's a problem. So, that's one of the considerations we have and why we haven't done anything with those yet. That, and we also own, plenty of sneakers through Vans. Generac CEO says pressure on the power grid is only going to get worse from weather and technology. We agree. But we did hit the window with the options when it surged to 176 on the Helene fears by the rumor sell the news. We haven't sold a share of stock. We think it's going to work higher over the next few years. And if you remember, we were pounding the table well below 100, 80s, and now it's 175. So Kelly Blue Book report, new vehicle prices at end Q3 lower year over year. Incentive spending increases for the third straight month. So this is exactly what we've been saying what would happen. They would get the lots back up to normal. Then you would see incentives. Then you'd see lower rates. Then you would see prices come down. And then you'd see volume go through the roof. And the OEMs would have a race to the bottom, crushing each other with price and margins. And Cooper Standard would be smiling all the way to the bank as they just provide based on volume. The lower the price gets, the more incentives, the more volume we're going to see because the average car on the road is over 13 years old. Same story. And now playing out. And if Morgan Stanley is correct and we're at 16 million SAR, that 200,000 could be a big deal. We've done some calculation. It's about $150 a car. And once they get over 15.8, the break even is basically 100% margin. So, you're talking $2-3 a share of earnings for every $200,000 of 200,000 cars above 15.8. So it's meaningful. The key thing is not to get tied up with, if they do 16.4 million SAR, it'll earn $6 and therefore I'll have a $90 stock at 15 times. The key is that they're going to earn well more than $7 a share well before the cyclical SAR peak that happens every cycle of 17.5 to 18 million North American SAR. We're nowhere near that, and they won't have to be anywhere near that to earn $7. They could probably do it with their eyes closed at 16.8, with a 16 handle on it. They'll be able to earn over $7, which is what we want to see. And the multiples moving forward. China shores up property sector, signals more spending is coming. Boeing cut 17,000 jobs, delay as jet strikes. So they're basically sending a message loud and clear to the strikers. If you think you won't be part of the next 17,000, think again, because you're having an impact, but we're going to fight back and we'll be the last folks standing. Let's come to a reasonable deal. And they also Boeing has filed a complaint, filing unfair labor practice charges against the union, saying that they're negotiating in bad faith and they're not being realistic. And I think a lot of people looking at a six-figure job, working on an assembly line, making six-figure income, and many people working very hard as well, making a lot less than that and not getting 30% raises, are probably looking at this similarly to how they looked at the port strikes with the head of the union making $750,000 with Bentleys in his driveway and an 8,000 square foot house and saying something doesn't smell right here. So let's hope they come to a amicable solution that benefits both parties and move on to doing what the world needs, which is more planes. Why Chinese stocks will climb another 50% from current levels, research CEO says. That's Jeff DeGraff. I think he's being conservative, but that's natural in the first stages coming out of the abyss. Fed's Goolsbee says rates are way above normal. Expect more cuts. We agree. This is GXO could see $85 per share in potential takeover. I think that's coming from a Jefferies analyst. And then Alibaba, Lazada, courts Armani, Dolce & Gabbana to fend off Shopee and TikTok in Southeast Asia. So they're, like I said, as you get the recovery, all the trinket stuff goes to hell and the quality stuff Baba controls. CSRC, this is from Brendan Ahern over at Crane Shares. CSRC Chairman Wu King will give a speech at the 2024 Financial Street Forum annual meeting on October 18th in Beijing. He's expected to speak to the 9 national measures supporting corporate governance, including Chinese company paying dividends and buying back stock. Real estate stocks rose as banks in Beijing, Shanghai, and Shenzhen pushed through a mass shortage refinancing at lower prime rate plus 30 basis points. China says it has big stimulus coming, but it won't say how big. Well, we got some indication from Caxton Global saying that it's rumored to be $6 trillion, hat tip to Marcel Munch over on Twitter. And that equates to about $840 billion over the next 3 years, which is monstrous, TARP-like if you consider the size of the U.S. economy versus China, and to do a TARP-like stimulus at this stage in the recovery is absolutely amazing. What if Warren Buffett had faced Kamala Harris's unrealized capital gains tax from the outset? Here are the numbers, and maybe people are starting to realize how silly some of the policies are, in that effectively Buffett would be worth $15.6 billion instead of $271 billion. Remember, he gave about 100 away to charity. Buffett's by far the richest guy in the world. The problem is, if you care about Buffett rankings, Forbes rankings, he gave away almost half of his money so he could be below Musk and Zuckerberg and all those, and Gates, because he doesn't want to be number one, because he doesn't want to get called every day. So he'll let those guys get pestered every day for donations. Hedge fund manager who could be Trump Treasury Secretary says tariffs can be negotiated lower. Okay, so they're setting the stage that they're not going to blow things up with China. They're going to lean on them to benefit U.S. workers and U.S. businesses. Boeing to sell at least $10 billion in shares to plug cash drain. We covered that. Alibaba to be added to the Hang Seng Stock Connect Hong Kong Index, Hang Seng China Technology Index, etc. We covered Alibaba's global unit pushes translation-focused AI model for merchants and individual units. Claudia Sahm of the Sahm Rule says her namesake recession indicator may have been a false alarm this time. We talked about that when it was hot. Alibaba and Baidu invest in China's self-driving IPO, how it measures up to Tesla. So they already have, this company already provided nearly 900,000 rides in China. Again, if you want an AI ETF, leaving aside all the other benefits of owning Baba, no company has more investments in AI startups than Baba, because they just say, okay, we'll give you cloud computing credits, you give us equity in your company. And it's unbelievable. I think that a lot of the gains are going to be from things that we don't even know that we don't know. You're going to have some of these AI startups that are 1,000 baggers that we own 10% of, and we don't even know that we own 10% of it, and it accretes to Alibaba shareholders. Xi urges officials to work on growth target for fourth quarter, which means if you don't make 5%, I kill you. And kidding, not kidding. Chinese stocks attractive, but investment managers cautious before the election. It'll be too late by the time they get certainty, because the idea is don't let people in, just like they didn't get let in September. And they're not going to get let in. Even at 98 is not getting let in. When you had a chance to buy in the 50s and 60s and 70s, 98 is great, but it's not the same game. Here is the article of the week: liquidity plus complacency, stock market and sentiment results. Boy, we've got a lot of stuff this week, which is exciting. You can see the notes that we had. We talked about VF Corp and Cooper Standard. Here's the data from Morgan Stanley on Cooper Standard. Here, 16 million SAR, up from 15.6. That'll be so up from the trough of 23.9, and up from the trough of 13.9 rather, and pretty exciting. It's and then next year they're estimating 16.2, which would be amazing. So, and I think it'll be higher next year, by the way. Because the other thing is, I don't know if you noticed, Trump made a proposal not only to make generators tax deductible, which would be unbelievable for Generac, but also to make car loan interest payments tax deductible. I mean, it's like I sent the guy my portfolio, and he's like, "What could I think of that would make Tom Hayes' clients even richer than they already are?" It would be unbelievable from a business standpoint. You couldn't ask for anything more. We will see, one, if he is elected, and two, if he can get those things through. But man, that would be a turbo boost for what we're trying to do here. Baba update: if you forgot what David Tepper said 3 weeks ago, that he was above his position limit for China, and if his number one position is Baba, I think he overall has 20-something% in China. And he said if we got a pullback in coming weeks, he would exceed the limit again by adding more. So here's the pullback. You know what David Tepper's doing. The question is, what are you doing? And I hope we get a little bit more weakness and be able to take advantage of it. So here's that article: 840 billion in new stimulus should be the number. Bank of America Fund Manager Survey update we put out on Tuesday. Here were the key points. Read the whole thing if you have a chance. There's a lot of great data. We're only going to cover 5 key points here. The last time we saw this abrupt move, a 2 standard deviation move out of bonds in 1 month, was 2001 to 2003. Again, and which preceded some of the biggest moves in history for U.S. small caps, emerging markets, and China equities. So here you can see the last time you had this kind of move out of bonds so abruptly. Again, 2002, 2001, 2002, 2003. And what happened next? Small caps up 165%, emerging markets up 432%, and the Hang Seng up 304% in the following years. 2, managers are still at levels of global growth pessimism reminiscent of past lows in equities. They haven't been this low since 18, since 2009, since 2001, etc. Investors reduced exposure to defensives and rotated into cyclicals this month. What did we talk about last month? Move out of defensives and into cyclicals, and that's what's happening right now. Materials and energy are the most underweight, both about 1 standard deviation below their long-term average. Underweight, so there's going to be some opportunities there. We've got Comstock Resources in that space, and we will Albemarle on the materials side, and we'll look to add more. Short China equities is still the 3rd most crowded trade this month, even after the full reaming they took in September. More reaming to come. We're going to get this one off the list for sure. Fear and greed got up to 70, so it's getting closer to like, maybe we're due for some consolidation. National Association of Active Investment Managers didn't really get up to levels. Well, let's see. Maybe they updated it today. NAAIM. I think they update it tomorrow. Yeah, they update it tomorrow. So, moving right along. Okay. Blah, blah, blah. Congratulations to all the new clients that came into Q2 and Q3 raises. We reopened to smaller accounts, the $1 million plus again, starting earlier this month, and will remain open till the end of this week. So get your inquiry in by Friday if you want to come in. This has been our biggest raise of the year by far, which is exciting. So see if you qualify and to take advantage of this opening, click here. The larger $5 and $10 million plus accounts can access bespoke service at any time here. So again, that is under money management. Click there and fill in the forms. October Bank of America Global Fund Manager Survey. This is the full Monty here. So go through that at your leisure. Communication services earnings estimates, top 30 weights in the last 60 days have been revised up for 2025. 2024 is no longer relevant, up 22 basis points. Top 30 weights of technology for next year have been revised down by 30 basis points for 2025, which is in line with what we say. Subdued indices, opportunity in the unmagnificent 493 small caps emerging markets. It's value over growth. So that's that. So the podcast is over. We're going to start the Ask Me Anything questions section. For those of you who'd like to stick around, please do. For everyone else, it's been a great hour. Okay, first question comes from Robert Peters. What do you think of Silvaco? Fell sharply after guidance lowered a little. Overreaction. From Robert Peters. They help semiconductor manufacturers with their tech software. I'm probably going to say no, but let me take a look first. SV. CO. Okay, so this company's been around for 5 minutes. It's dropped from $21 down to $8. I don't invest in companies that don't have a long history of data that I can see how management operated through all different types of cycles. So this is an absolute no for me without even looking at the financials, because there are not enough financials for me to look back at. And sure, we'll miss some opportunities doing that, but all I need to see right here is negative free cash flow, and that's enough for me. So no, pass. It's a trading vehicle, not an investing vehicle, but thank you for sending that in. Ben Stiller. Okay. Yeah. Okay. Ben Stiller. I know you're a fan of Brad Jacobs. Do you ever invest in companies like QXO? Well, we talked about it at the podcast. We do have a position in QXO at 1157, and pretty big one at that. So on to the next question. Caleb Lusby. Thank you for all the great content and insight. What are your thoughts on Dollar Tree? If you don't want to discuss that, I'd love your thoughts on Ulta. As a dad with a daughter, I got to believe they are making money, good money. Thanks again, sir. From Caleb Lesby. I got my eye on both of them. I'm not doing anything on either, but they do fall in the area of consumer discretionary that I want to be in. And I think you've got a keen nose, and you'll probably be right on both of them. But I think it's a little early. I mean, let's take a look here. And Ulta. Yeah, I mean, I think both of these are going to work. These are both positions that I've done some work on, and I'm just kind of waiting and watching. I mean, the whole thing here is, in order to outperform, you're never going to overperform. Very hard to outperform with more than 15 positions, and we usually try to run 8 to 12 or 13. So the good is the better enemy of the better is the enemy of the best. So we can put new positions in, newer portfolios that we don't want to put them into positions that have already run 50, 60, 70% for existing clients. So that's where names like this can come to play. And then as we harvest other things that have gone up a lot, like a bunch of the options in Generac and Baba and all that stuff, then we can start to put them into names like this. But I do like both of these names. I think they're both going to work for you, whether today's the day to buy some or 2 months from now. I can't tell you that, but I think if you have a long view, I think you're in good shape. And well done, Caleb. Sam R., what's your thoughts on Chinese people's sentiment not following the bazooka stimulus? There's no evidence of that. I mean, someone sent me a message about LVMH was down because of China. Like, look, at some point people get tired of $30,000 handbags. Let them take a break. Let them look at the 20 in their closet and get tired of that after the next 2 months. And they'll be back out buying Ferraris and LVMH handbags once again. It's just not going to be tomorrow. So this idea about sentiment and stuff, this is short-term noise. The bottom line is the government's going to jam so much liquidity into that market, it is going to continue to go up in serious size, in fits and starts. Matt Holleran asking about Cooper Standard. Yeah, look, it's not a perfect formula, but yes, the margins are very high because all the fixed costs are in and the parts are very cheap once you get about 15.8. It's about 150 a car, so that's what I would use, but that doesn't include all the pricing concessions that they gained, which they renegotiate every year or two. So it's an imperfect formula, but I think the $3 every 200,000-300,000 cars is the way to look at it, and I think it's going to be better than most people expect. So that's round numbers. You can't be that precise because as that money starts to flow in, management will screw it up. So it's not going to be perfect, but it's going to be better, well better. The key here, Matt, is working with a crayon, not a scalpel. And my view is that you'll probably get to $6-7 a share in earnings between 16.5 and 17.5. Actually, 16.5 US SAR and 17 versus what it took in past cycles of 17.5 to 18 to get to the same earnings power because of how well they've got the business set up now for the next inflection. So that's all you need to know. You're not going to get it one-to-one in that way, but certainly I think the first few 100,000 cars is going to shock a lot of people, and that's where the biggest bulk of that is. Garrett, hi Tom, always the highlight of my week to listen to the podcast. Thank you. As so few in the hedge fund asset management industry offer such a service, I was wondering if you had a read on LVMH after earnings. It seems like this also hinges on China's thesis. Yeah, I mean, the issue with this one is that it's going to trade. I mean, it's and that's the other issue I had with buying Lulu or Nike is it's just a double. You want to try to have a couple handfuls, less than a dozen, as uncorrelated bets as you can get. So trading LVMH and owning Baba in size, you're kind of doing the same thing. It's a bet on China's recovery. So if you don't have BABA, then you should take a good look at LVMH. If you have BABA, you kind of it's kind of the same trade. Only not as good. So I think you're there. I think you're a hair early on that one. Philip Laird, your podcasts have been very insightful. Keep up the great work. Thoughts on DXCM? I think this is a diabetes thing, if I'm not mistaken. We've looked at this one in the past. The margins are declining materially, but their revenues keep going up. So you got to understand how are these margins going to start to recover? I mean, they're still decent margins at 63%, but they're falling off a cliff even as cash flow recoveries. Let's see, is this software or is this diabetes? It's probably software. Medical device company. Continuous glucose monitoring systems in the U.S. and internationally. Yeah, so just figure out what their mode is. If you remember, Baxter got rid of that business. I think you're probably going to be okay. That was sold off in line with the GLP scare. I like the idea. I think you really got to understand what they have and how it's unique, and then go from there. But as far as everyone getting on GLP-1s and losing weight and not being diabetic anymore, the data we looked at during the scare showed that virtually these things are going to be annuities. It's like owning cigarette companies. They're going to keep generating cash. They're going to keep buying back stock. So you're probably okay with that one without doing the work. In other words, I'm saying go ahead and do the work. Start listening to the conference calls. Start reading the annual report. Start doing channel checks on competition, et cetera, et cetera. Matthias Becker, just so you talked about Intel trading at tangible book. Meaning if it got liquidated, you'd get back around $20 a share. It's very comfortable. Yet here in Germany, a small battery manufacturing, mostly for Apple AirPods, is bankrupt, but they do not pay tangible book to shareholders. Instead, they confiscate the shares for them. The shareholders are left with nothing, no compensation. This is according to German law called Starrug. Sounds like a bland joke about the communist community, blah, blah, blah. Are you aware of similar laws in the U.S.? No. Okay. Trying to learn more from David Tepper. I heard he had problems with Russian bonds in 1998. Government let them default. Okay, so Matthias, number one, the guy's compounded money in over 20% for decades, one of the few in the world. So he had a bad trade with Russian bonds. Like, shit happens. And then on to the next. What about the other 300 trades that he did well? It's so funny. While we've been waiting for Baba to work, we probably put out a dozen double pluses on this podcast, and everyone's focused on Baba and so excited that it moves $40. It hasn't even started yet, and people are so excited about that. But the other dozen or so double pluses, no one cares about. I mean, it's you can't make this stuff up. So the point is look, this is America. If there's excess equity after the bondholders are paid, you get it back. In the case of Intel, there would be. And in the case of that ever happening, that's Looney Tunes. It's at $52 billion in revenue. The government's backstopping it. They need the fabs, and that's the whole story, not whether you get back your $20. As far as what happens in socialist Germany, I have no idea, and that's why I don't invest there. Dave Jones, question about, you think GXO gets bought out? I hope not. If they do, I would think it will be around $80, but time will tell. Robert Little, what do you think about ticker CETX? Doesn't seem like it should have a $112,000 market cap. Okay. Obviously a new listener. Offers browser-based video monitoring and analytics. This is more of this Me Too BS stuff. This is nothing. This is not high quality. This is not durable cash flows. This is gambling stocks, which we have no interest in. So, Robert, I implore you to listen to many of our past podcasts, start to learn a framework that I learned from following Buffett, Munger, Benjamin Graham, all the greats, Tepper, Lee Cooperman, etc. That's durable, that works over time, and companies like this where you're trying to get rich quick on a penny stock is the surest way to blow up your account and never get rich. So we'll leave it at that. Rob Kowalski. Hey, Tom, love the show. Do you have any thoughts on nuclear, uranium, commodity stocks like Kamiko? No. So nuclear is all the hype now. So these things will trade for a week and then they'll blow up. The big trade we had on that made a multi-bagger very quickly was Rolls-Royce, and we were playing the airline service recovery and got the benefit of the SMRs, which are 10 years out, by the way. So they're very speculative at this point. There will be a way to play that. It's not right now. So let all the maniacs chase the shiny objects, run them up, and then crash in the next 6 months. That's not what we do. We're not gamblers chasing the next hot idea. JT, we're chasing the surer ones. Schlumberger and oilfield services companies keep getting my attention. What is in your opinion on Schlumberger? Would you prefer to own a single high-quality name like Schlumberger, Baker, Halliburton, or play it through OIH diversification while positioning for a rebound? I keep looking at these. They're not cheap enough for me yet, or they may never get there. Yeah, I've been looking for a play here for a while, and they're just higher and better uses of my money. It's not now. Tim Wang, thoughts on Celsius Holdings. Got my eye on it. Not doing anything yet. May never do anything, but I am spending time on it. I'll leave it at that, but probably not going to ever do anything with it. Eric Walker, Carnival. All right, so this thing has already had a run. We talked about this years ago in 2020. And now that it's doubled, everyone wants it. So let's just take a look. Yeah, I mean, the issue with this was the balance sheet. It'll probably go up to $30, but I don't know if it's going to go a whole lot more than that this cycle because of what their balance sheet looks like post-COVID. But the people that were buying it during 2019 and were able to hold through, it's okay. Wasn't the best use of capital, but it's a decent trade and will work higher. Drew Robinson. Hey Tom, huge fan of the podcast. Before I get into my question, wanted to mention the Walgreens employee vape comment in last week's episode was too good, so relatable. Anyway, what is good entry point for Tesla? Difficult to determine whether Robotaxi and Optimus are priced into the stock. I'm curious what your thoughts are. I've never bet with Musk or against Musk, and I have my reasons for that, which I cannot discuss on the podcast. But I would never bet against him. And if you get an opportunity to invest in SpaceX at anything below $500 billion, it probably makes sense. As far as robo-taxis and all this other stuff, it's just not what we do. We look for high-quality companies that are trading at reasonable valuations that have pretty sure doubles. This one, I've even looked at it recently, and I don't make bets on guessing technologies in the future. It's not where you make durable, predictable money. So with that, it's just, I hope it works for Musk and the world. I'm not going to participate. Jim Jones, with the recent rally into China as a whole, do you think that Ant Group will IPO in 2025? Yes, probably. And what would be the overall effect on the price? I think the valuation goes from 30-something billion to 100. And that'll have reasonable impact for Baba's shareholders over time. Bob Johnson, semi-long-term listener, frequent contributor of mediocre ideas until today, hopefully. TWL, Dolius Group on London Stock Exchange, Auto Parts Company, joint venture, Chinese to spin off their metallurgy business. Look, I'm telling you, I've been doing this for a while. I'm putting new clients in Cooper Standard at $13 all day long. Yeah, the ones that have been with me for a while have it at $5 and change, but I think $13 is like unbelievable. So I wouldn't really want to mess with this at all. Let me take a look at the balance sheet. My guess is their balance sheet is toast based on the way the stock is trading. Cash flow, I mean, they're not even anywhere remotely near to cash flow break even. So for me, I'm out. But keep them coming, Bob. I think you're going to hit a home run on the next one. And let's see, Jason Z, Celsius, are you still looking at it? Yeah. Continue to look at it. Continue to do nothing. With that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Thank you for listening, and bye for now.